Welcome everyone to Vested Interest. This is Shane back for another stock pick of the day video. It is June 6th, Thursday. This will be the last one of the week, but tune back in on Sunday morning. We'll do our portfolio update. We are going to take a look at UGI Corporation. This is out of the energy sector. Let's jump right in. Before we get too deep into the video, if you take a moment and hit that thumbs up button down below if you find any value in the content. If you are a dividend growth investor, make sure you subscribe to the channel. Join us on this journey to financial freedom. Join the Vested Interest community. Make sure you are subscribed. Hit that notification bell so you're notified whenever we put out any new content. I do these stock pick of the day videos Monday through Thursday. I also do subscriber recommendations. So if you have a company you'd like me to cover in this series, go ahead and drop it down in the comment section down below. Drop a comment. Let me know what you think of the videos. And share with anyone who is a dividend growth investor that you know, or an investor in general, or someone that you want to get invested or interested in investing. Maybe you have a daughter or a son or a nephew or niece out there who you think maybe just finished high school or college, getting their first job, that should be putting some money away in the market. Maybe this is a way to do that. I know sometimes, at least with my kids and some of my nieces and nephews, they won't necessarily listen to me because I'm just that old crazy uncle telling them what to do with their money, but they might listen to somebody else. So share those videos. Really do appreciate everyone out there who's taking the time to watch, comment, and subscribe to the channel. Very, very appreciative of all the subscribers out there. Thank you all so much. Now, this is the Vested Interest Stock Screener. This is how I set up these stock pick of the day videos, right? So we're going to run through this criteria. At the end of the video, we'll take a look and see if it meets 5 of 8. If this was a financial company like a bank, we would look at price to book. This is not. It's out of the energy sector, so we will not be looking at that. You can use price to book for any company, but if you do use price to book outside of banks, banks are easy. You just use a 1 being fair value, anything under 1 being undervalued, anything over 1 being overvalued. Again, that's for banks. Now, other companies like this, you would want to compare to similar companies in the same sector, see how their price to book stacks up against other companies, 2, 3, if not 4 companies, and that would give you a better idea of where they sit. You can also look at price to book over the last 2 or 3 years for the same company and see where it falls, and that should be able to show you, for example, if a company's price to book was 4 typically over the last 3 years and all of a sudden it's down to a 2 or a 3, that might speak to some undervaluation. That's just another way to use price to book as a valuation tool as well. So we'll run through this criteria. This is how I set up the videos. It's also how I look at a stock on a high level to see if I am interested. And just because it meets 5 of 8 or 6 of 9 if it was a bank, that does not mean I am buying shares of that company. That just means it goes onto my watch list. Then I do more of a deep dive looking into the balance sheet, income statement, looking at their revenue. Is revenue growing over time? Looking at their margins, looking at their sales. There's other detail in the income statement and the balance sheet that you should be looking at outside of this. This is just an initial screener because there's thousands of stocks out there, so it gets me through stocks pretty quickly to see if I'm interested at all. And if it doesn't meet 5 of 8 or 6 of 9, I just bypass it and move on to the next one. And you can tweak this, right? Don't necessarily just use this screener. You may have other criteria that you want to use for your screener. Maybe you like to look at revenue right off the bat. Maybe you like to look at the PEG ratio instead of the price to book. Maybe you like price to sales better than price to book. So you can tweak this. This should just be something you use as a starting point, not necessarily copy it blindly. We all have different timelines for our retirement, different investing journeys. Some of us like more growth, some of us like higher dividend yield. It's all up to how your investing criteria is set up, but you can use this as an initial starting spot. Now back over to UGI. Go ahead and check them out at www.ugicorp.com. That's www.ugicorp.com. That is their homepage where I pull this information from. International distributor and marketer of energy products and services, including natural gas, LPG, electricity, and renewable solutions with well-developed infrastructure in key markets. By operating as a best-in-class service provider, offering a great place to work, serving our communities, and delivering value to investors, we aim to positively impact our lives or shareholders, employees, customers, and communities. So just like it says, they offer electricity, natural gas here in the United States, primarily in Pennsylvania and West Virginia. And you can see here over on the right, that's a map. So the red here, this little red area right here, that's where their electric service is. Their gas service, where they provide gas service, is this blue. And in West Virginia, it looks like they do gas as well. So Pennsylvania, blue, West Virginia Gas is the orange. So that's their area that they cover for electricity and gas in the United States, but they also have an arm across the world where they provide, I don't know if you've ever been to, maybe you have a gas grill at your house and you see those UGI containers that you can hook up to your gas grill. Well, that's UGI. That's the company, or one of the companies, not the only one of the companies that provide gas. So whether it's here in the United States or overseas, if you have a gas grill, maybe you're using products from UGI. They were incorporated back in 1882. It is interesting. This part of the reason I like doing this series. It does get me into a lot of companies. I learn a lot along the way. So I really do like this series. And I like that you guys like the series. It seems to be helping grow the channel. But you can see here, if you go to their homepage, you can see their history going all the way back to 1882. Incorporated in Philadelphia, Pennsylvania as United Gas Improvement. There's the UGI, right? United Gas Improvement Company, becoming the first public utility holding company in the United States. I did not know if they were the first one in the United States, but again, I do like this series because I do learn a lot about different companies, not here just in the United States. We did Nestle yesterday, which was a company out of Switzerland, so companies all around the world. So that's one of the reasons I like this series as well. And hopefully you are all learning something along with me. Now let's keep going. The reason we're taking a look at them, down 6.35% on the day, huge drop on the day. That'd be a huge drop for the year, let alone the day. We are talking about UGI Corporation, ticker UGI, out of the energy sector, and they closed out there. I'm sorry, they may be out of the utility sector, actually. They closed out the day at $23 per share. It doesn't look like they're moved in the after hours, at least whenever I pull this information. You can see that drop, huge drop on the day. 52-week range as low as $20.19, as high as $29.74. So at $23, they are closer to their 52-week low, pretty much right up against it. They could drop a little bit lower, not a whole lot, before they'd have to be setting a new 52-week low. They have a market cap of $4.821 billion, a beta of 1.15. So they are more volatile than the overall market. They do not list a price to earnings ratio. If any of you have been watching this channel for a while, you know I don't like that. It typically means it's in the negative. Their EPS, earnings per share, is in the negative. I do not like that either. Earnings date, July 31st through August 5th. So sometime in there, tune in here coming up next month or into early August. They'll be putting out some of their earnings reports. Tune in for that if you're interested. Forward dividend is $1.50 paid out in the year. They are a quarterly payer, and they have a very high starting dividend yield, 6.11%. Ex-dividend date, coming up here June 14th. Look like they're going to pay out on July 1st, so you would be in line for the dividend if you were to buy them now. Now on the ex-dividend date on the 14th, you want to buy at least the day before the ex-dividend date. Don't try to buy them on the ex-dividend date. Depending on how your brokerage allocates who owns those shares, it could be the person that owns the shares on the morning of is the owner, and the person who owns them on the next day. So you might not get the dividend if you buy them on the ex-dividend date. I always recommend buying at least a day before. And that's so that whatever brokerage you use it depends on how they allocate the shares, right? Just because you buy them on that day, they may not show ownership until the end of that day, which would really be the 15th. So again, at least a day before the ex-dividend date. Now we're going to jump over and look at, I don't think we covered here, 1 year target estimate, $30.67. So they actually see it setting a new 52-week high here, a little bit higher than the $29.74 that it's been over the last calendar year. So a little bit on the price appreciation side with a very high starting dividend yield. Let's jump over and look at dividend yield theory to see if this one is potentially undervalued. 5-year dividend yield average, 3.98%. We compare that to the current, 6.11. Over here, it's going to say forward, same number, 6.11. And since it is higher, and it is much higher, that is not only higher, it is higher with a huge margin of safety compared to their 5-year average. That speaks to undervaluation on this one. So at least according to dividend yield theory, this one would be potentially undervalued. Now remember, dividend yield theory is just one of many, many metrics. Excuse me. Payout ratio, I like 75% or less. This is sitting at 160.11. That is way too high. That screams this one is potential danger of a dividend cut here, right? Anytime you get above, anytime really, in my opinion, you get above 75%, you need to start watching, unless it's a REIT or a business development company or something like that, where they typically pay out 90% or more. These companies here, this is not good. 160.11% of their free cash flow paying out their dividend. They're having to do something. They're either issuing more shares, they're taking on additional debt, something here, or they have cash on hand that they're burning through to pay out the dividend here. So I don't like how high the payout ratio is on this one. Again, this one may be in potential danger of the dividend being cut. Let's jump down to free cash flow. We want growing free cash flow over time because typically if a company has growing free cash flow, they have a growing dividend. Going back to 2020 here, you can see 447 million. 2021, big jump up to 791. 2022, it's where it starts to get a little wonky. Negative 88 million in free cash flow. Back up again 2023 to 133 in the positive. They were repurchasing some shares over 2022 and 2023, so I do like that they've started that. Way back here in 2020 they did as well, but for some reason not in 2021, even though they had a big jump up in free cash flow. So I'm not sure why they didn't do that. Maybe they were overvalued or something back then, or they were just doing some other things with them. Maybe they were paying down a significant amount of debt. Not sure, but this would have been whenever I was buying back shares if it was me, if the price of shares was even close to undervalued or fair value, because that's a big jump up in free cash flow. So overall, no growing free cash flow. 2023 is lower than you were back here in 2020, and it also less in repurchase of capital shares here as well. Now we're going to jump over to stockanalysis.com. Now I recommend more than one source whenever you look at companies so that you make sure that the information is accurate and up to date. And as you can see here down at the bottom, price targets were last updated on May 3rd. So this information from stockanalysis.com is a little over a month old. And that's part of the reason I recommend more than one source. Sometimes the information is outdated. Sometimes the information could be incorrect. So always look at more than one source, 2 if not 3 sources, to back check information is correct. Now they only have 2 analysts that have taken a look at this. They call it a consensus hold. I'm assuming both are calling it a consensus hold. Low estimate $27. It currently sits lower than that, so that would be a 17.44% increase if it came back up to their low estimate. Average estimate 27, high estimate of 27. So they just have a $27 estimate across the board. Again, currently sits lower than that. Now we're going to jump into statistics here. Look at return on invested capital and return on equity. I like 10% or better for these numbers. Return on equity, negative 1.5, not good. Return on invested capital, negative 3.64%, not good. So this would not meet the criteria I'm looking for. I like 5% or better EPS forecasted growth over the next 5 years. They don't have it listed, which leads me to believe it's negative. And their revenue growth is negative over the next 5 years, negative 0.02%. So almost flat, in the negative just a little bit. Let's run through their dividend history and wrap this one up. Quarterly payout ratio, again, we saw 160 there. They're not listing it here, which leads me to believe it's negative. They do show dividend growth of 3.09%. I question whether they should be growing the dividend, and if not cutting the dividend. Like I said, a payout ratio of 160%, even if it's over 160 and not quite, or over 100 at not quite at 160, that's too high. So in my opinion, they shouldn't be growing the dividend. They should be pausing it at best, if not cutting the dividend to get their payout ratio under control. 37 years of growth, buyback yield of 0.4%, shareholder yield of 6.79%. So those are good. At least when they're buying back shares, they're getting a positive return on that. Now we're going back to December 2021 here. They were paying 34 cents. Their payout rate date is January, April, July, October. I like that they pay out. There's not a lot of companies that pay out in the January, April, July, October timeframe. Most are in the March timeframe. Excuse me. But going back to 2021 here, you can see December 2021, they were paying 34 cents and some fractions of a share. June 2022, they raised it up to 36 cents. June 2023, up to 37 cents and some fractions of a penny. And it looks like that's where it's remained ever since. So unless they raise it in the December report out, it doesn't look like, because it looks like they're on a June time frame for that raise, but they did not raise it here. So maybe they are pausing the dividend. But look for that in July whenever they pay out here, their next payout. So let's run through the screener here. Understand the business. That's where we always start. Growing free cash flow last 4 years, no. Growing dividend, yes, 3%. But again, I question whether they should be doing that and not pausing, if not cutting the dividend with 100+% payout ratio. Dividend payout ratio 75% or less, absolutely not. Check valuation based on dividend yield theory. According to dividend yield theory, they are potentially undervalued, but is that for a reason? If you're looking at the numbers and they're all negative, that's a bad reason. Buy below current cost basis or within 15% of a 52-week low. At $23, they are right at 15% of their 52-week low. I think it's like $23.13 or 26 cents, somewhere in there whenever I did the math. Hold on one second. I think I still have it on my phone. Let me look here. What was it? Looks like it was, oh, I didn't save it. Sorry. It was right around $23.13, I believe, was 15% of its 52-week low. So at $23, it is right there, but just barely. Return on invested capital, return on equity, was not 10% or better, and their earnings per share growth was not listed, which leads me to believe it is not 5% or better. Leads me to believe it's negative. So overall, only 4 of the 8 we're looking for. That would not make it onto my watch list. This is not one I would be interested. Needs to get a little better in the return on invested capital, return on equity, or the earnings per share growth needs to be better, or they need to get their payout ratio under control. One of those 3 needs to happen or they're growing free cash flow. One of those 4 needs to happen, needs to start growing over the next 4 years and need to be projected to grow into the future. So one of those 4s would need to happen for me to be interested in adding this to my watch list and doing more of a deep dive on that one. Well, that is really it for this one. Let me know what you think of UGI. As always, appreciate you stopping by. And if you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the vested interest community. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future stock pick of the day video. So if you have a company you'd like me to cover, go ahead and drop it down in the comment section below, and I'll work it into the rotation. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Hope you have a great weekend, and we will see you in the next one. Again, don't forget to click that notification bell so you're notified whenever our future videos come out, and we will be doing our portfolio update on Sunday morning. We'll see you back for that one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. So I'm only sharing my opinion and investing journey for educational and entertainment purposes. If investing involves risk, you can't lose money. You should never invest any amount in conclusion. Always do your own research. Invest based on your situation, circumstances, and select criteria, or seek the advice and counsel of a certified financial advisor.